I'd like to open it up now for questions. We have probably, in the interest of running out of time or having run out of time, I'd still like to see if anybody out there would like to just put your hand up and we'll get you a microphone.
You said Europe, and particularly peripheral Europe, is going to become more competitive. I wanted to ask, who are they going to become more competitive vis-a-vis who? And what is the trade impact on Asia? I haven't heard anything about the trade links impact in anticipation.
Peripheral Europe, competitiveness, trade impact. It's going to be a long, difficult process of economic restructuring, because many of the manufacturing industries that existed in some of these countries have gone because of the loss of competitiveness during the construction boom. So labor costs have to fall, investment has to come back, and that will start to generate additional employment. So it's going to be a long process. The trade impact on Asia is small. Right? Asian exports are hit by the U.S. They're hit by the large European countries of Germany, the U.K., France, and those economies are more competitive, especially Germany, because German labor costs have actually risen much less, and their unit labor costs have come down in a way that preserves their competitiveness, and that's a problem for Europe, right? So really the trade impact is much less than the impact that comes about as a result of the transformation of the financial system as a consequence of the lessons learned from the crisis, where banks overinvested in the peripheral countries using a very fragile funding model that really underpriced liquidity in a fundamental way. So it's not the trade links that matter here, it's really the sort of broader financial links and the regulatory response to the crisis.
What's the reason oil prices are not following the slowdown? Usually when the markets are going slow down, oil prices is quite active, besides geopolitical issues.
So basically, there are three categories of commodities, right? You have this energy-related commodity, you have the metal-related commodity, and you have the agriculture-related commodities, right? Three types. Agriculture is something probably was still going to be stabilized, volatile, but they're probably stable and going up because the nutrition demand of the global population is still going up. And if you look at metal, it's going to suffer dearly. It's probably going to drop another 50% from what has dropped from here because nobody has realized how much slowdown it will take. And for energy, it's a little bit trickier. There are a few confluence of forces going on here, right? If you look at the supply side, you'll have the U.S. and Saudi, especially U.S. is going to become the largest, maybe energy exporters, not just the producers. Of course, I mean, there's still a lot of controversy about how much, how stable the tight oil, for example, or LNG they can export, right? And in terms of supply side, you also have the Iran, right, which probably will get resolved within the next 5 years, probably next couple years. But those are probably kind of counter-influence evenly to each other. And if you look at the demand side, demand will still keep going. I mean, no matter how, basically if you look at the Chinese household, even if as a nation, China's become the largest energy consumer, but per capita wise, it's still very, very, very low. If you look at across Asia, the same thing. This will happen. This will happen. Of course, I mean, eventually oil could become just like another piece of relic that people only put them into museums. Nobody uses them anymore. I mean, after we use up all the oil and all that, the price might be sky high, but it's not really in circulation anymore. That's probably the future of oil. But in terms of short term, energy price, I think they're going to be relatively stable. And by the way, another big demand is China's strategic reserve. they have a goal, I think about 400 million barrels or whatever, and they have about 150 million barrels now. So they have still a big gap there. Whenever oil price dip, they're going to go in and start to buy. So that will provide a cushion to the oil price as well.
My question is, as you mentioned that the European banks are all deleveraging, and also, I guess, with the implementation of Basel III, we're all confident that the banks will no longer be able to go back to the booming days of the 2006, 2007, that period. So I just want to ask for your personal view on the banks. Should the banks sort of go back to the more traditional way of just taking deposits and putting aside capital and then doing what they do, like lending and stuff? Or should they kind of consider going back to this wholesale lending or borrowing model and then going for the auxiliary business, like the investment banking and that kind of stuff? Like, what's your view on how the banks should kind of, proceed from this point on into the future?
It's dangerous to try and fight the last war. You can't go back and rewind the clock and pretend that you can start over again. The financial system is different now, and it's incredibly more complex. And when you think about the crisis in the financial system, what you need to look for are the failures in the ability to manage and price risk, all the agency problems that led to excessive risk-taking in the financial system. Right? We can see those, and they need to be addressed, they need to be corrected. Right? And really that is how you deal with the problem of financial stability. Splitting up investment banking and commercial banking, returning to the world of when everything was safe, really was a world which was quite inefficient in its allocation of capital. I think part of the problem is the spillovers between one form of risk-taking and one form of banking and another that really allowed very risky activities to piggyback on the guarantees that are provided by the government and really the massive funding capacities of the large global banks, right? And I think if you want to look at one fundamental problem of banking, it is moral hazard that comes from the massive the guarantees, implicit guarantees by the government of private losses. And this is really what regulation tries to control, but clearly regulation failed because it failed to address the problems of how that was circumvented. And so I think we're at a crossroads now, right? We understand the nature of the problem, but often we can't see what is happening. And part of our challenge in surveillance, the IMF and by the regulators, is to see that and really try and force banks to price liquidity risk, to price credit risk properly, and to deal with the problems of corporate governance. But turning back the clock and breaking up banks to make them all too small, I think is in my own personal view, not the IMF's view I should add, is something that really is beyond the realm of the possible.
And I'd like to thank everybody for coming out tonight. Sean, thank you very much for a great presentation. Thanks to my esteemed panelists here.